The market clearly has a lot of concerns about the Fed's plan to battle inflation. Right now, inflation up 8% over the last year, well over the Fed's target of 2%. And I think we're past calling it transitory officially now. Now, you share a lot of these concerns, but specifically, let's talk about what you're most concerned about. Is it reducing the balance sheet, the rate increases, or is it the timing of all of it?
Well, it's a little bit of both. You know, they're tightening into an environment where the GDP is actually slowing already. That's been reflected in the flat yield curve. They're not essentially compensating bond investors for time. We're seeing that with earnings per share guidance. The earnings per share guidance is actually negative. More companies are negative for 3 consecutive quarters. So that was already bad enough that they're tightening by raising the Fed funds rate. But the balance sheet, I think, has spooked the markets in the sense that, and just to add context, the Federal Reserve's balance sheet has increased from $1 trillion in 2008 to $4.5 trillion in 2014 to close to $9 trillion today. And if you were to look at a chart of the S&P 500 and the Federal Reserve's balance sheet, they're almost in lockstep. And so there are really two ways you can reduce the size of the balance sheet. You can allow the bonds to roll off, which means that those bonds, as they mature, are not refinanced. There's $1 trillion in treasuries that are going to mature in 2022, another $1 trillion that mature in 2023. Or they can get more aggressive and actually start selling bonds that are on the balance sheet. And that's far more aggressive than I think the market would tolerate, because not only are you rehypothecating debt, you're pulling money out of the economy, but you're also now putting the Treasury Department in a position where they're competing with the Federal Reserve as they issue bonds to pay for deficit spending. And that may be one of the reasons you're seeing yields on the long end start to rise.
All right, so obviously the market's concerned about a lot of this plan. One other thing I want to touch on, I know you're very concerned just about consumer spending right now. Obviously, last year we had $1.2 trillion in stimulus. Very unlikely we're going to get anything like that this year. That's one of the reasons why you're actually staying away from tech and growth stocks. So you're down on those, but what areas are you bullish?
So I'm bullish on gold. You had the segment on Russia. And, so what the United States has essentially done is they've weaponized the U.S. dollar. And so that might incent some of the sovereign wealth funds and central banks to actually buy gold in their portfolios. But also gold does well in an environment where you have disinflation. It's not that inflation is going to go down. It's just not going to go up at the same rate it did last year. So anytime you see on a rate of change basis, inflation and the economy decelerate, gold has done well. And then obviously there's some bond proxies like utilities, consumer staples, REITs. These are things that are defensive in nature. And then it'll be interesting to see what happens with bond yields, because it may come to pass that as the economy slows down, bond yields stop going up and the Fed stops getting as hawkish as they are. That would actually make bonds more attractive, but particularly if it's a safe haven trade. So it remains to be seen if bonds on the long end actually become a way to be defensive in this environment as well.